Welcome to the Deep Dive. Today we're taking a monumental stack of complex financial reports, expert forecasts, and some pretty dense international regulatory analyses.
And we're boiling it all down into what you actually need to know to navigate, well, what's probably the world's most disruptive technology.
Yeah, exactly. Our focus today is on the incredible and, let's be honest, often paradoxical journey of cryptocurrency.
We're trying to move far beyond just the day-to-day volatility. Our mission really is to synthesize the foundational mechanics of Bitcoin, track this astonishing speed of institutional and government integration, and really map out what this landscape looks like by 2030 and maybe even beyond.
It's a huge topic.
It is. We're looking at its evolution from what was basically an anti-establishment protest philosophy to what is now a multi-trillion-dollar globally regulated asset class.
And the backdrop for all this is, it's pretty dramatic right now. We're looking at sources from late 2025, and they're putting Bitcoin trading at around $104,000.
And that's after a recent peak that sailed past $125,000.
Right. So for a lot of people, this is already a wildly lucrative asset. But the real question isn't just how high it trades this month. It's what happens when central banks, massive corporations, and all this deep tech from Web3 collide with this decentralized structure.
It's about understanding what drivers are truly foundational to the growth, and how the twin pressures of institutional money and state regulation are shaking its future.
Okay, so let's unpack this. I think we have to start right at the philosophical root, the mechanics of trust. At its core, Bitcoin, BTC, it's the flagship, right?
Yeah.
It's digital money designed to work without needing a central bank or a government middleman.
And that decentralized mandate is just absolutely critical to understanding the entire ideology. It is no accident that Satoshi Nakamoto's white paper arrived in 2008.
Smack in the middle of the global financial crisis.
Exactly. It wasn't just a technical paper. It was a very explicit coded critique of the centralized, opaque systems that had just failed the world.
And that criticism wasn't just in the white paper. It's baked into the very first record of the chain.
It is. The very first block of data ever mined. It's called the Genesis block. It had a hidden message.
What was it?
The headline from the Times newspaper, dated January 3rd, 2009, it reads, "Chancellor on brink of second bailout for banks."
Wow.
Yeah. So that time-stamped headline serves as this permanent, undeniable reason for the system's existence. It's like a monument to the failure of traditional finance.
That is powerful. So the technology itself replaces faith in people and, institutions with faith in pure mathematics. For listeners who still find blockchain a bit intimidating, how do we simplify that core mechanism?
Okay, so think of the blockchain not as a database held in some single bank vault, but as an open, shared community ledger, a permanent chain of blocks that stores every single transaction.
And it's shared everywhere.
Exactly. It's replicated and distributed across thousands of independent computers globally. The reason it's so trustworthy is that the math, the cryptography, guarantees that once a transaction is added, it's irreversible. It's impossible to tamper with.
So that level of permanence and security leads some of the authors in our source material to label Bitcoin as info money. What does that mean for the average person, that we're now calling this an evolutionary form of currency?
It's a fundamental shift in perception, really. Traditional currency, fiat money, requires you to trust the government not to hyperinflate or the bank not to fail.
Right.
With info money, your trust is in the public, auditable kind. The system is designed so that once a payment is confirmed, it's finished. Done. No one can reverse it.
Unlike a credit card chargeback.
Exactly. And you retain pseudonymity while the ledger itself remains completely public for anyone to see.
Okay, that tracks. So if the core promise is trust and math, the core value proposition has to be scarcity. Unlike national currencies, which can be printed infinitely, Bitcoin is hard-capped at 21 million coins.
That hard cap, that fixed supply, is the foundational economic driver. And the mechanism ensuring this programmed scarcity is called the halving cycle.
Which happens automatically.
Automatically, roughly every 4 years. It's when the reward miners get for validating transactions is just cut in half.
And we've seen that happen over and over. It started at 50 BTC per block in 2009, then 25, 12.5.
And after that crucial halving in April 2024, the reward is now just 3.125 BTC. And this schedule is non-negotiable. It's what makes Bitcoin predictable in a very unpredictable world. The final fraction of the last coin is projected to be mined around the year 2140.
And that scarcity is what makes its history so legendary.
Yeah.
You have to mention the first known real-world purchase. The two pizzas.
The 10,000 BTC pizza transaction. Infamous.
I mean, can you imagine? At the time, that 10,000 BTC was worth about $40.
And today, that amount of Bitcoin is worth hundreds of millions of dollars. It's the ultimate cautionary tale about exponential growth.
But the scarcity is actually amplified by this fascinating and kind of painful detail our sources revealed: the sheer amount of permanently lost BTC.
It's a huge factor. It really is. Estimates suggest that 3 to 4 million coins, so that's like 15 to 20% of the total supply, are just gone. Forever inaccessible.
Wow.
Yeah, and that includes the nearly 1 million coins that Satoshi Nakamoto is believed to own that have never been moved. Not once.
And you read these individual stories like the British programmer who just threw out a hard drive in 2013 with the key to 7,500 BTC on it.
Ouch.
I mean, you can't help but wince. It was worth millions then, but today that loss just makes the remaining supply even more exclusive and therefore more valuable.
That's it. Loss enhances the scarcity factor. But, you know, if scarcity is the value driver, the technology has to deal with the opposite problem: how to scale up for mass adoption.
Right.
Historically, Bitcoin struggled. That original 1 megabyte block size limit caused really slow confirmations and super high fees.
Yeah, if you want a global currency, you can't have high fees for just buying a coffee. So what are the key technical fixes being used today to solve that bottleneck?
It's basically a two-pronged solution. First, you've got segregated witness, or SegWit, which optimizes the existing block space.
Okay.
But the real game changer, the thing everyone is excited about, is Layer 2 solutions.
So give us the simplest analogy for a Layer 2 solution like the Lightning Network.
Okay, think of the main Bitcoin blockchain as a national high-security bank vault. It's slow, it's expensive, and it's really designed for the final settlement of huge assets.
Got it.
The Lightning Network is like building a temporary private channel between you and a coffee shop. You can handle thousands of tiny, near-instant purchases off the main chain without constantly bothering the main vault.
And then you just settle up at the end.
Exactly. Once you're done for the week, you just record the final net balance back on the main Bitcoin chain. It allows for speed and volume without sacrificing that main chain security.
That technological evolution, solving that scalability problem, that leads us perfectly into the major forecast for 2030. What kind of market cap are we looking at?
Well, the forecasts are ambitious, and they're almost all driven by the expectation of institutional money finally flowing in. Analysts are predicting the aggregate crypto market cap will comfortably exceed $10 trillion by 2030.
10 trillion.
With some optimistic scenarios placing it closer to 20 trillion.
A market that size means blockchain has to be used for a lot more than just payments and speculation. Where else are the reports suggesting we'll see it applied by 2030?
We're seeing massive expansion into verifiable data management. So supply chain tracking, medical records security, transparent digital voting systems, and verified digital identity.
This is all part of the growth of Web3, right?
Absolutely. Web3 is fundamentally changing the internet from a system where big platforms own your data to one where you own your digital assets.
And a big part of that governance are these decentralized autonomous organizations, DAOs.
Yeah. DAOs use blockchain rules instead of, traditional corporate hierarchies. It makes project governance transparent and managed by the stakeholders.
And what's the tech driving this shift?
Well, it's these scalable Layer 2 solutions we just talked about, especially for complex networks like Ethereum. But we're also seeing AI beginning to integrate with smart contracts.
How does that work?
AI is mainly for automation and efficiency, so managing risk, optimizing transactions, executing complex contracts autonomously based on real-world data. Plus, you have the growth of whole digital ecosystems like the metaverse, all requiring this secure ledger infrastructure.
And we can't ignore the sustainability question. There's a big push for green blockchain initiatives to reduce energy consumption.
Which is becoming more and more important as institutions adopt these systems. All these leaps are paving the way for the institutionalization we're forecasting.
So the original idea was to build a currency outside of government control. But now we're looking at a future worth tens of trillions where government integration is absolutely central.
It's a huge pivot.
Let's get into that regulatory reality as of May 2025. What's the first major trend?
The first is international settlements, where crypto has just become indispensable. The numbers are staggering.
I saw this in the report. Global transfer volume using just 4 key assets, BTC, ETH, and the stablecoins, USDT and USDC peaked at $2.6 trillion in 2021.
That's equivalent to 12% of global trade volume.
Wow.
It shows crypto's inherent advantage in cross-border payments. It reduces costs, and critically, it enables transactions between countries that don't have established banking ties.
And this has a geopolitical angle, too.
A huge one. Nations like Russia were in the top 5 for Bitcoin use in 2023 and 2024 for these transfers, even with their own domestic bans. It's a systematic way to bypass traditional sanction-prone systems like SWIFT.
So that sets up this fascinating internal battle.
Yeah.
The state versus private digital money. On one side, you have central bank digital currencies or CBDCs.
Right. And many major economies, the EU, South Korea, are actively testing these. Their goal is often retail use or for distributing government subsidies efficiently.
And they want control.
They want control. Critically, some nations are designing these systems to be strictly for payment, explicitly blocking them from being used as investment vehicles.
But the U.S. is taking a strategically opposite approach, favoring private stablecoins.
Which is all about protecting dollar hegemony in the digital age. Through legislation like the Genius Act in May 2025, the U.S. Congress is focusing on tightly regulating licensed payment stablecoins.
And these have to be 100% backed by real reserves.
Exactly. Cash and short-term U.S. Treasury bills. So by favoring private dollar-pegged stablecoins, the U.S. blocks its own CBDC development and leverages private innovation to secure the global role of the bank.
Of dollar, just in a digital form.
Yeah.
It's a really savvy move.
It is. And that brings us to the ultimate sign of institutional acceptance. Bitcoin as a strategic national asset. The protest currency is now becoming a treasury holding.
The ultimate irony.
It really is.
Well,
In 2025, the U.S. created a strategic Bitcoin reserve, mostly from confiscated assets, and defined BTC as an untouchable treasury asset, right alongside gold.
and El Salvador is still on its 1 BTC a day accumulation policy.
They are, specifically to build a long-term national reserve and avoid the risk of bad market timing. And this isn't just a fringe idea anymore.
Right.
In Europe, we're seeing countries like Switzerland and the Czech Republic modeling extreme scenarios, doing formal risk analysis to see if they should include BTC in their official reserve structures.
That's a huge shift from skepticism to serious contingency planning.
Mhm.
Okay, so we have this undeniable institutional demand. Let's talk price. We're standing around 104,000 in November 2025. What's the immediate pressure driving near-term forecasts?
The single biggest driver is institutional inflow through regulated products. The net inflow into U.S. Bitcoin ETFs has just been massive.
I saw the number, $9.1 billion in net inflows just in the first half of 2025.
Exactly. And that kind of steady demand stabilizes the price, even through corrections. And it forces analysts to rapidly adjust their expectations.
And some of those expectations are pretty wild.
They are. I mean, major banks are publishing targets that were unimaginable just a few years ago. You have JP Morgan with a forecast of 170,000, Standard Chartered with an ambitious 200,000 by the end of 2025.
But the numbers get truly mind-bending when we look further out, toward 2030 and 2050. What are the upper bounds of credible projections?
Well, the consensus range for 2030 is broad but high. It's typically between $300,000 and $700,000.
Okay, that's already huge.
But the really optimistic projections from firms like ARK Invest, they're forecasting figures up to $2.4 million by 2030.
2.4 million.
And maximum scenarios reaching a staggering $6 to $10 million per coin by 2050.
But to hit those high numbers, the asset has to be doing more than just sitting in a natural reserve or an ETF, right? That requires a fundamental change in its daily use.
That is the core condition. You're absolutely right. Those highly optimistic forecasts are entirely contingent on achieving genuine global mass adoption. Bitcoin has to fully transition into a global payment system and a globally recognized reserve asset.
Which is only possible with those layer 2 technologies we were talking about.
Exactly. It's only feasible if things like the Lightning Network successfully solve transaction speeds and costs for billions of users.
So we've covered the philosophy, the trust mechanism, scarcity, and the regulatory environment. What's the core takeaway when we merge the origins of Bitcoin with its trillion-dollar institutional future?
The journey is just marked by rapid paradox. Bitcoin started as a critique, a decentralized protest against the financial system. Now it's rapidly becoming a fundamental, regulated asset class that is actually strengthening and competing with those same state structures.
It's a hybrid system.
It's a hybrid system where centralized finance CeFi and decentralized finance DeFi are merging. where private assets like regulated stablecoins and Bitcoin coexist and wrestle for dominance with government-backed CBDCs.
Which brings us right back to that tension at the very beginning. The goal was a leaderless currency, resistant to centralized control, yet